Shopify's transaction and loan losses spiked 76% year over year to $141 million as the merchant lending book keeps growing, the one crack in an otherwise elite quarter. In this video, I'll grade the report, then walk you through how I'd trade it. Nothing here is financial advice. Shopify gets graded and traded. So on the headline, revenue came in about 4% ahead of estimates at $3.58 billion, and get this, that's up 34% year over year, broad-based across every merchant size, every channel, every geography. On EPS, they beat by about 13.5%. Now the reported net income was $1.5 billion, which looks massive, but about $1 billion of that came from unrealized gains on equity investments, not the actual business. Strip that out, and the clean operational net income was $439 million, still up around 30% year over year. Really solid, just not the monster the headline suggests. So, on the beat itself, and grading against the clean numbers, not the equity gains inflated headline. This earns a B. A 4% revenue beat plus roughly 30% clean earnings growth is a strong quarter, just not a blowout. And on consistency, Shopify has been remarkably reliable quarter after quarter, stringing together beats with meaningful magnitude. This one earns an A. Let's talk about the positives from the report. Revenue was up 34% year over year to $3.58 billion, and the key word is broad-based. Merchant Solutions up 37%. Subscriptions up 22%. Every merchant size, every channel, every geography contributed. This is not a one-segment story. And this is the one that matters most to me. Operating income nearly doubled to $488 million, up 68% year over year. Revenue grew 34%, but total operating expenses only grew 21%. That's real operating leverage. The exact thing bulls have been waiting years for Shopify to prove. Free cash flow hit $654 million at an 18% margin, up from 16% a year ago. Cash generation grew 55%, way faster than revenue. This is a business that's genuinely converting scale into cash. Gross merchandise volume. Basically, the total dollar value of orders running through Shopify hit $115.5 billion, up 32%. That's the engine underneath everything else, and it's still humming. And monthly recurring revenue, which is the annualized run rate of subscription plans, grew 19% year over year to $221 million. That's a forward indicator that the subscription line should keep compounding into next year. So on profitability, this earns an A. Operating income up 68%, free cash flow up 55%, margins expanding across the board. This is what real operating leverage looks like. Now let's talk about the negatives from the report. The Q3 guidance implies deceleration. Revenue is guided to grow at a low 30s rate versus the 34% they just posted, and gross profit at a mid to high 20s rate versus 31% actual. Still excellent in absolute terms, but this quarter may be a local peak on the growth curve. The reported net income of $1.5 billion is heavily inflated. About $1.06 billion of that was after-tax unrealized gains on equity investments. Strip those out, and the clean operational number was $439 million. The business is genuinely growing 30%, but the headline overstates the underlying earnings power. This is the one I'm watching most closely. Transaction and loan losses jumped 76% year over year to $141 million, way faster than revenue growth. As Shopify Capital's loan book expanded to $2.18 billion, credit risk is building. If consumer spending softens, this line can compress margins quickly. Cash and marketable securities dropped to $4.95 billion, from $5.78 billion at year-end, mostly because of the $1.42 billion buyback. Liquidity is still plenty, but the cushion is shrinking as they return capital aggressively. And Q3 operating expenses are guided to 33 to 34% of revenue, which is essentially flat with Q2. So the operating leverage story that shined this quarter doesn't have another step up baked into the near-term outlook. So on guidance, this lands at a C+. The Q3 outlook still calls for excellent growth in absolute terms, but the deceleration on both revenue and gross profit, combined with no further OPEX leverage, means the guide itself is not the tailwind bulls might have wanted. And on red flags, I'm at a B-. The 76% jump in transaction and loan losses is the one item I can't dismiss. The merchant lending book keeps growing, and that's the operational risk that could actually crack the margin story if the consumer weakens. When you strip out the equity gains noise, this was a genuinely elite operational quarter. Revenue up 34%, operating income up 68%, free cash flow up 55%. Shopify is finally proving it can compound growth and expand margins at the same time. The Q3 guide points to modest deceleration, and the growing credit loss line is the one thing I'm watching, but the durability question is now clearly answered. Putting it all together, I'm giving this print a B+. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash-secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding. Find the one that best fits your situation. Okay, let's get into it. The operational story here looks solid, but I think a lot of that strength was already baked into the price heading into the print. So instead of chasing shares at these levels, I'd rather sell cash-secured puts into any post-earnings consolidation and get paid to wait. With 34% revenue growth and an 18% free cash flow margin, I've got a real fundamental floor underneath me. For me, I'm waiting for a pullback before I do anything aggressive here. The third quarter guidance calling for low 30s revenue growth is strong enough that I'm comfortable selling cash-secured puts into any weakness. But with the guided deceleration and that credit loss line jumping to $141 million, up 76% year over year, I'm not reaching for premium at the money. My strike floor needs to survive a 10 to 15% post-earnings pullback, which is pretty common on high multiple names, and I only sell strikes I genuinely own. So for me, I'm selling cash-secured puts well out of the money on this one. This print validated the entire operating leverage thesis I was betting on when I bought these shares. Operating income up 68% year over year and free cash flow up 55% is exactly the combination that keeps me in the name. The only reason I'd trim is if the position has grown oversized relative to my portfolio, and even then I'd scale out gradually, rather than dump the whole thing. So for now, I'm holding my shares. If my covered call strikes are meaningfully out of the money, I'm letting them ride through expiration. The third quarter guidance implies some deceleration, so I'm not expecting the kind of aggressive upside move that would put my strikes at risk. But if I had strikes near the money and expiring soon, I'd roll them up and out to grab more premium and give the position some breathing room. For me right now, I'm letting my out-of-the-money strikes ride. This print is exactly what I needed to see as a long-dated call holder, with operating income up 68% and free cash flow compounding at 55% year over year. Monthly recurring revenue growth of 19% gives me forward visibility on the subscription side, which is the whole reason I own the long-dated calls. I'd only take partial profits if my position sizing had gotten excessive, and I'd wait for a pullback before rolling up to get better economics on the roll. So I'm holding my leaps here. This release validates the original bull thesis I had on the name, so I'm not walking away from the position. 34% revenue growth, expanding operating margins, and $654 million of free cash flow are not the numbers of a broken thesis. I'll scale in on weakness, but not chase strength, given that deceleration guidance, and I'm watching the credit loss line at $141 million, up 76%, as the single biggest risk to the margin story. So my plan is adding only on weakness. Bottom line, this print earns a B+ from me. The operating leverage story is validated, and free cash flow is compounding faster than revenue. That's the combination that keeps me constructive on the name, even with the Q3 deceleration and the credit loss line I'll be tracking closely. Thanks for watching, and I'll see you on the next one.